like the rest of the world, we've seen a high inflationary environment with high interest rates, so that has put pressure on households. But even then, that inflation is starting to come down. Rates have come down. In the long run, that's really good for South Africa.
Technology is embedded in every aspect of our lives and laying the foundation for the future, from finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories on the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Annabelle Brewers in Hong Kong. I'm Sherian in Tokyo. Watch Bloomberg Tech Asia. New episode Friday, only on Bloomberg Television.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg.
Welcome to Bloomberg this weekend. I'm David.
I'm Lisa McKay. And I'm Christina Rafini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. Ledger is really propelling the deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have to better. We got a big week coming up in politics.
Earnings season's underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Now is the time for the economy to be really accelerating. And there's not much evidence that that's actually happening.
I'm really nervous about the economy for the next few months. There's a lot of different pulses pointing in different directions right now. Recession seems a long way off.
We think in an environment where the Fed maybe still has 1 to 2 rate cuts ahead of it.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. Your scores, the price action looks like this. Equity futures pretty much unchanged on the S&P 500 following 2 days of decent gains led by tech. Software doing nicely until this morning. The Nasdaq futures are down by, let's call it 1/10 of 1%. Two names to look at. Let's start with Salesforce. Salesforce cannot get out of the penalty box. That name is down by 3.6%, even with a $50 billion stock buyback. The other name, the obvious one, Nvidia. Fantastic numbers, and yet here we are. The stock is only up by 1% in early trading.
And it's a tale of two different industries, right? NVIDIA got it done. Nothing you could poke a hole with in terms of their earnings report. The increase year over year is just tremendous. The fact that they've got 75% profit margins, what can't they charge their hyperscaler customers? With respect to Salesforce, a really different story because they didn't show the acceleration that a lot of people were looking for. Nonetheless, what will it take, given the fact that Mark Benioff sounds very happy? He's talking about not the Sascopolis, but the Sasquatch, which, again, I'm trying to wrap my head around. But nonetheless, it does seem like this market is permanently in, what was it again, AI derangement syndrome?
Yes.
I think that that's exactly perhaps where we are.
I don't know if you've done any research calling that phrase a little bit earlier this morning. Abby Rowan's going to join us in a moment. She said this, it's like Nvidia's winning the game, but investors are giving participation prizes out to all the other players.
It seems like right now, NVIDIA is the ultimate winner of $650 billion of CapEx spending for hyperscalers, and yet people are looking beyond that and saying, actually, it might be beneficial for everyone or for nobody. There are a lot of unanswered questions, and a lot of these papers that are going viral about whether it will completely eradicate white-collar jobs, I'm talking about the deployment of AI, go to the heart of the fear. Can it be that we get this sort of nirvana-like productivity boom that leads to benefits for all, or are we going to end up in the same post-globalization reality that you've talked about, where suddenly blue-collar jobs will shift overseas? Is it going to be a similar kind of apocalypse in the white-collar space? We can't answer that question. Even Fed officials themselves are struggling right now.
Well, as they struggle, what I found interesting this morning is whether it's Frank Lee or Angelo Zeno, talk about the fact that what they've had from NVIDIA, what they delivered, is everything they expected. Both of these analysts said they didn't know anything different, which is probably why maybe we're not seeing the stock actually take off. That matches the numbers that are just absolutely blockbuster.
What is the shopping? Johanna will get you up to speed on the details of that in just a moment. In some ways, the numbers can't come out anymore, right? You're following the earnings coming out of this stock, out of Paramount, and you're sitting there thinking, who wins the race for this one night?
And evidently, people can't make enough money at a company that is losing money, right? I mean, we're looking right now, we're talking about how NVIDIA is losing cash, $100 yours. We're talking about Warner Brothers losing, sort of declining in revenues, losing about 10 cents per share versus the estimate of 3.8 cents a share. And you're seeing some prescribers come in light. It doesn't matter, because ultimately this is going to be somebody else's problem and somebody else's opportunity. And frankly, it's a different kind of drama.
Stand by, we're getting more details on that name in just a moment. Coming up on the hour, we'll catch up with Emily Ronan of John Hancock as the equity market rally stalls. Dan out of Wedbush, a strong Nvidia earnings struggle to impress. Matt Brill of Invesco as AI capex debt continues to swell. We begin this hour as big tech struggles to impress. A blowout quarter for Nvidia, failing to spark a market rally. Emily Ronan of John Hancock Investment Management writes in the following: it's amazing the market doesn't seem to care. It's like Nvidia is winning the game, but investors are giving participation prizes out to all the other players. Emily joins us now for more. Emily, welcome. I think a lot of people feel the same way this morning. Looking at those numbers yesterday evening, looking at the price action this morning, and Emily asking themselves the question, what is going on?
Yeah, John, there has never been anything like this in U.S. corporate history. 80% year-over-year earnings growth. The estimate was 57% on a $5 trillion company. Like, this is just so remarkable. And then you wake up this morning and you look at the relative winners again, and it's the Kospi, it's Europe, it's the CAC, it's everything else except U.S. technology companies. The market cap of Nvidia hasn't really changed very much over the past 6 months, and meanwhile we've just seen massive multiple expansion, massive changes in terms of the size of pretty much every other company on the planet. We've been talking about this sort of idea of March madness coming up. To us, it's momentum madness that we're watching. And you think about the brackets, it's Spain, it's the Kospi, it's Europe, it's silver. That's really where the focus has been, and the markets are really not all that impressed by Nvidia. Pretty remarkable to us, given the strength of the earnings, the margins, the revenues there.
And you saw it as soon as the year started, straight out of the gate. The Kospi off to the races. South Korean equities are up by close to 50% year to date. We're not even 2 full months into the year. You talk about the momentum. The team's going to have plenty of questions about tech and what's happening stateside, but the momentum that's happening elsewhere, do you really want to fight that right now?
I mean, momentum, as we know, is a really powerful force. Matt Miskin and I have been watching the Kospi for about a year now. It's up 160% over a 1-year basis, and we're always trying to square that with what the fundamentals look like and what the economic picture looks like in some of these countries. You look, for example, at Europe. The estimate for earnings growth this quarter was 3%. They barely beat that, and then European equities are on fire. In the United States, the earnings growth estimate for this quarter was 8%, and we're coming in at 15%. That's almost double. Technology companies just produced 33% year-over-year earnings growth in the United States. It's not getting rewarded. Look at Japan. Their stock market's on fire. Guess what their GDP growth is? It's 0. They just missed a technical recession. So it's just hard to really square this momentum, this sentiment, this technicals that are driving these markets with what's really happening underneath the surface. We want to participate in this, but investors might want to think about right-sizing positions in a market that's been driven by momentum.
At the same time, Emily, U.S. markets have already benefited from momentum, right? I mean, you look at Nvidia shares, they've gone from $3 essentially at the beginning of 2019 to almost $200 today. I mean, it's been a tremendous blowout in terms of market capitalization. How can you understand, when we're talking about such big numbers, what that's baking in, and how many more multiples to price in at a time where there are many beneficiaries, clearly, and the race is very, very intense?
Yeah, absolutely. And the earnings engine is on in the United States. So when we think about valuations, we really care a lot more about the denominator. And we've seen that, especially in some of these AI beneficiaries. But we just saw so much momentum. To your point, last year, it's just going to be hard to repeat that, to continue to compound that. So we understand this idea that there's catch-up potential in other areas of the market, but we are always following earnings. We believe that stock prices follow profits over time, and that's where the earnings are. Now, do you need to protect against the valuation risk that's inherent in some of these big, large-cap companies, tech companies in the United States? Absolutely. So what we're doing is we're looking at sort of our favorite, more quality cyclical areas of the market. Industrial is a top idea for us for quite some time. We're going down in market cap and looking at mid-cap stocks, which have elevated earnings growth prospects and at least like reasonable valuations in a world where everything is expensive right now. So it's about owning tech, it's about looking for the earnings, following the profits, but then diversifying from that down in market cap and looking for quality value.
Emily, is it a contradiction to go down in market cap, to go to smaller, riskier companies and also like high quality bonds? I mean, is it a contradiction here betting on the reacceleration of the economy on one hand, but then on sort of the opposite on the other?
So great question. So it's a key reason that we're overweight mid versus small cap stocks. We look at small caps, they're lower quality. 40% of the Russell 2000 index is comprised of unprofitable companies. We really prefer to be up in cap to mid caps, which are not our parents' mid cap stocks anymore. These are pretty large companies. But on the fixed income side, that's an area that we just think is mispriced. With the 10-year treasury yield still over 4%, there's an opportunity, especially in the intermediate part of the curve here, to lean into that. Bonds returned 4 to 5%, 7 to 8%, like very quietly last year. We think that can happen again. Now, there's not as much value at the shorter end of the curve now. Given the moves there, investors can benefit from roll down. They can get income. We don't think that bond investors are sniffing out the disinflation and the lower growth that's coming down the pipeline. And that's an area that we think offers some relative value across markets.
Emily, if investors like utilities, materials, and some of these more tangible assets, aren't they also part of the AI trade? You have to have a case that the AI build-out is going to be real.
Oh, that's a huge part of it. These are traditionally more defensive assets, but they're also benefiting from the build-out of data centers around AI. We're looking at industrial production, automation, robotics as key themes. So these sort of old school, parts of the economy, parts of the market are also, benefiting from this AI build-out. The lack of supply that's needed in order to build the infrastructure here. So, we're looking at that as an opportunity, again, to sort of look at the tertiary beneficiaries of AI here.
So what if the market view that as the AI trade is real, and when you see blockbuster results like you have from NVIDIA overnight, that you want to buy into it even more this morning?
Yeah, absolutely. And I think, Avery, the challenge is just the size of this. You look at how important the market has become to the economy, and it's just remarkable. Consumer net worth right now is sitting at a record $176 trillion. The stock market is $60 trillion, dwarfs the size of the U.S. economy right now. So we've seen this incredible capital appreciation that's been driven by AI as being the most important thing. The market is like the tail that's wagging the dog of the economy. It's usually the opposite. So we want to think about diversification given the fact that there's so much wealth that's concentrated in AI, and it puts us in a little bit of a precarious position. If we do see a challenge here, there's a lot that's been written, of course, as of late around software companies and the obsolescence potentially there. We think that is overdone, but we've got to think about how much of a risk there is given this massive wealth concentration in the AI trade, and think about other ways, other assets to own to diversify from that, whether it's infrastructure, whether it's bonds, whether it's utilities, etc.
Emily, it's good to see you. As always, thanks for jumping on. Emily Ronan there of John Hancock. It's easy to forget how big some of these companies are. More than 4.5 trillion. Imagine telling someone 40 years ago that the biggest company on the planet would be close to $5 trillion, and Nvidia something like 4.7. US GDP in the mid-80s was about $4.5 trillion. These companies are massive.
Which is the reason why, as we're saying that NVIDIA is barely moving or barely responding, up almost 1% is up almost $50 billion. So, we're talking about not nothing. So at a certain point, are we just reaching sort of warp speed here, and any incremental gains is just a massive amount of money still?
Futures so far this morning just about unchanged with the Nasdaq and on the S&P 500 with an update on stories worldwide this morning with the Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. World Economic Forum chief Morgan Brenda is stepping down over his ties to Jeffrey Epstein. In a statement, Brenda said it's time for the forum to continue its important work without distractions. The left thanked Brenda for his contributions and leading the successful meeting in Davos in January while announcing a new interim president. Meanwhile, shares of Warner Bros. Discovery edging higher in the pre-market following its earnings release just moments ago. The company reporting adjusted EBITDA for the quarter that beat the average analyst estimates. The results coming as the bidding war for Warner Bros. Is heating up. Investors awaiting the final word on whether Netflix or Paramount Skydance will seize control of the Hollywood giant. And over in
struggling to impress.
I think right now the street really is more focused about the risk tied to AI, more so than the growth opportunities here long term from AI. And I think that the street's really trying to grasp the two sides.
So if you want the bull case, you speak to the bull himself. Dan out of Wedbush joins us next, live from New York City this morning. Good morning.
Shipping is the backbone and the engine of global economy. Practically everything our society needs gets transported by sea. But the mere size of it means that it's responsible for 3% of global emissions. Global regulations are vital to progress society towards net zero. Today, the industry is seeing a delay in making decisions. This creates an environment where there is a level of uncertainty of what happens next and what that means to the world. What we've learned being a 100-year supplier for the marine sector is at times of uncertainty, the best thing to do is to up the collaboration. When we work with our customers on research and development, as well as technology for methane abatement, what dual fuel vessels to choose, we can really help them beyond just being their supplier and work with them to help the solutions of tomorrow be ready when they need them.
In this episode, we explore why the era of simply searching for answers is over.
Agentic AI has to be designed around responsible AI. Can you audit? Can you trace? Can you control? The risk we run is to create systems that recursively learn and change without the signal and the switch to turn them off.
So things at the index level feel really snoozy once again within 1%. I think now within 0.5% of all-time highs on the S&P. Just about unchanged so far this morning on the S&P and the Nasdaq unchanged as well. Talk lots about Salesforce, more to come on Nvidia. Check out the banks as well. Citi yesterday had a really decent day by more than 4%. Citi this morning down by about a 10. So a great note out from the team at Morgan Stanley on the most defensible stocks. And some of their picks on the bank side of things, Citi, Bank of America, State Street. Here's the quote from them. Regulatory intensity, balance sheet requirements, relationship-driven models limit disintermediation. AI drives productivity gains across operations, risk and client service, supporting sustained operating leverage. This is why, from an AI perspective, some of the analysts over at Morgan Stanley like a few of these names.
Because ultimately, the big are going to benefit that much more from their platforms, as well as the fact that people need to go out and actually talk with their clients. We've heard this from the likes of many people at City Wealth and beyond. A question of who then this is a detriment for, right? We've seen that kind of cannibalization from other wealth management platforms. Is it going to be everyone benefits in this sort of nirvana-like productivity boom, or are we looking at truly the winners and losers in the market's trying to figure out who's who?
It just seems at the moment, Bramwell, we're spending too much time thinking about who loses. The fear has taken us in that direction, and not enough time, not sufficiently, and not enough time to focus on who's winning at the moment, or who might win further down the line and why.
It seems like right now people are saying like the U.S. is priced to win, and right now we're not sure whether everyone's going to win in the same way, so we're just going to go invest in the Cosby. And that essentially is what people are doing, even though there are going to be some very big winners, which is the reason why you're seeing Walmart, for example, really benefit. But why wouldn't the biggest banks also be on the right track?
A close to 50% move on South Korean equities yesterday was just phenomenal. Under surveillance this morning, Nvidia struggling to impress.
This changing AI narrative that we're seeing across the markets, right? And I think right now the street really is more focused about the risk tied to AI, more so than the growth opportunities here long term from AI. And I think that the street's really trying to grasp the two sides, but right now they're really focused the risk tied to the AI side.
So here's the latest this morning. Blockbuster earnings have a strong forecast from Nvidia, failing to spark a market rally. Concerns rising that an overheated AI economy may weigh on growth. Dan Ives of Wedbush raising his price target on the stock to 300 and writing this: Nvidia is at the beginning of this transformational superstar narrative playing out for the tech world. Dan joins us now for more. Dan, welcome to the show. I'm going to repeat myself. I feel like a broken record, but it's got to be asked. If that's the case, why has this stock done nothing for 4 months?
Look, I think right now, the street's this glass half empty view. You look at these numbers, these are Michael Jordan like. In terms of the beat that you saw in data center, the 78 billion for next quarter, that's almost called 500 to 700 bits above the street. But I think you hit it right now. Everyone's focusing on the losers, how AI is going to hurt. The reality is that it's all about CapEx numbers and data center demand. What you saw from Nvidia, the AI bubble essentially gets thrown out the window. And look, I think this is a stock that's ultimately up 3 to 5% today. And in my opinion, $300, as we talk about, that's probably base case to where this ultimately goes. I think we're just in one of those narratives, you follow the numbers, superstar performance.
And yet, Dan, you follow the market response too. The market's telling you that much of what you're saying is well understood and well priced. And now we're starting to get our hands around what the transition's going to look like to Rubin from here, starting to understand potential constraints, maybe even deceleration in CapEx from here. Dan, what's your response to all of those things?
Yeah, my response would be, if you look at physical AI today, it's less than 3% of revenues for Nvidia. And I could argue that's probably maybe 15 to 20% when you look at the next few years. That's not factored in. I think the street continues. If you think about over the last few years of Nvidia, they underestimate what the demand is going to look like. And when you look at the trillions of dollars of spending over the next few years, there's one chip in the world fueling it, but it's the derivative impacts. I think Jensen hit on in terms of the software doomsday trade right now. I call it an AI ghost trade. Software is going to play a huge role in terms of the use cases, and that's another ripple effect in terms of AI.
Yeah, the fact that they had 75% margins, to me, indicates they can charge whatever they want. That the demand is so great that they can raise prices significantly more than their input costs. And I just wonder, where is the competitive mode around that, right? How much better are their chips right now to allow them to charge whatever they want at a time where AMD's trying to come after them, Broadcom's trying to fashion chips for Microsoft and Google and all the others in order to compete with them?
Yeah, because right now it's their world, everyone else is paying rent. And I think I see they're probably 3 to 4 years ahead of any competitor. Look, their third-rate chip, an H200 restricted in China, even though obviously no revenues, that's better than Huawei, probably by a year or two. Look, obviously competition is going to continue to increase over time. Big tech will build their own chips. But right now, demand and supply is 12 to 1 for NVIDIA chips. And that's why when you look at those margins, you look at numbers, the fact that this is a stock that's under 200 relative to where I think ultimate earnings is going to play out. And I continue to view it as a table pounder name, despite obviously a muted reaction, at least initially.
Well, then how much do you see actually some competition being posed from the others? AMD got a lot of attention this week due to their arrangement with Meta. I just wonder, given how much they have raised prices, and given the fact that not everybody needs a Michael Jordan. Some people just need an average college coach or even a high school coach to help them get to the next phase of technology. Where do you see some of the pull coming from in terms of competitors?
Yeah, look, and if NVIDIA is the Jordan, like AMD could be the Scottie Pippen, right? The point is, AMD is going to play a huge role. Micron's going to play a role. You look down in terms of TSMC and just the whole derivatives on the supply chain. Look, obviously Intel's trying to get into the game, but just the reality is that NVIDIA is so far ahead. But you think about the spillover. Meta can't get enough chips from NVIDIA. They're going to have to go to AMD. And that's why AMD is one of our, the odds AI third, and it's a core winner in terms of everything Lisa Su is doing. It speaks to just this overall market opportunity. You're going to have trillions of dollars spent, and also for every dollar spent on NVIDIA chips or even overall CapEx, $8 to $10 multiplier across the rest of tech. That speaks to what I view as on software and infrastructure. Street is massively mispricing the ripple effects that's going to happen here.
At risk of totally derailing the conversation and pulling a TK, everyone wants to know who Dennis Rodman is. No? Dan, who's Dennis Rodman of the chip world?
Look, I think if you had to be Dennis Rodman here, that'd probably be the Palantir.
Yeah.
If I kind of had to put that in there to maybe go into that now.
That's a good response. I think I might like that too.
I'm impressed on the spot with that. And maybe the Steve Kerr would be the Microsoft.
There we go, something sensible. That makes sense. Now let's talk about another name, Salesforce. You've got an outperform rating on the name, 325 price target. That name is really, really struggling. Why are you sticking with it? We're at 184 and we're down 3% of the pre-market.
It's because it's my view. It goes back to, I think the most disconnected narrative and tack that I've seen in my career is the software doomsday narrative. Salesforce, look, have they struggled in terms of monetizing AI? Yeah, and I think Benioff would admit that. But they will be a winner over the next 12, 18, 24 months in AI. And it speaks to my view, like, call it 2-3% of revenue today, that's call it AI impacted. That's going to be 25% by next year. And I think they're laying out with Agent Force the narrative. They're starting to monetize. And I just look at the stock relative to free cash flow. I mean, I view this as kind of a 10% downside. You know, I ultimately think it could be a double in terms of the upside. And that's why that risk reward, I view it as a table pound here. I get right now New York City cab drivers, Barris and Salesforce, Barris and ServiceNow. But this will be viewed as the time to own these software names, and that continues to be our view and our thesis.
We'll see if that's the case, no doubt. We'll catch up in a month and we'll see where the prices have taken us. Dan, it's good to see you. Dan Oates there of Wedbush. Salesforce down in the pre-market and really struggling to rally. A lot of these things, we understand the bull case, and yet here we are with fantastic numbers behind us, and we're not getting that rally in the name.
Yeah, we're getting just a marginal rally because there just still are so many questions. I will just say a commentary from the audience. Thank you for this. Going down a dangerous basketball analogy road abort. So I think that I will stand clear of talking about this problem, but I thought that was actually pretty
What
funny.
kind of trouble do they think you're going to get in?
Embarrassing myself.
Oh, okay.
Horribly. You know, the whole
I
touchdown
would have
thing.
run out of basketball player names after that.
I was about to say, I want to know Huawei.
Through like the 90s Bulls, I haven't got much left.
That's
So
pretty
then go to Kobe and LeBron
Yeah.
and stop there.
Yeah, well, I'm not going to try.
A few others.
Take your advice, thank you.
As well. I'll take that advice too. Our next little program, terrible product, the NBA.
Oh my God. Of course we went back there. Come on.
Okay. Living Technologies President and CEO. Kate Johnson joins us next.
Shipping is the backbone and the engine of global economy. Practically everything our society needs gets transported by sea. But the mere size of it means that it's responsible for 3% of global emissions. Global regulations are vital to progress society towards net zero. Today, the industry is seeing a delay in making decisions. This creates an environment where there is a level of uncertainty of what happens next and what that means to the world. Well, we've learned being a 100-year supplier for the marine sector is at times of uncertainty, the best thing to do is to up the collaboration. When we work with our customers on research and development, as well as technology for methane abatement, what dual fuel vessels to choose, we can really help them beyond just being their supplier and work with them to help the solutions of tomorrow be ready when they need them.
Silence isn't empty, it's full of proof. When a silent gesture orchestrates masterpieces, we're not just one step ahead, we're in a league of our own. From 50 years ago to today to tomorrow, CIB has always been here. Growth, innovation, and setting the standard for half a century. Progress driven by quiet mastery.
In this episode, we explore why the era of simply searching for answers is over.
Agentic AI has to be designed around responsible AI. Can you audit? Can you trace? Can you control? The risk we run is we create systems that recursively learn and change without the signal and the switch to turn them off.
Welcome to Bloomberg This Weekend. I'm David Gordon.
I'm Lisa Matei. I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. Sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We had a big week coming up in politics.
Earnings season
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Guys, buckle up. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with the close. Weekdays on Bloomberg. Context changes everything.
Bringing you up to them in the news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg.
When it matters, investors turn to Bloomberg surveillance.
I said it maybe on your show here. I hear you guys talking about this a lot. Our investors are really thoughtful. They're engaged. They listen to your show.
As a number of the people you have on your show have mentioned.
If you talked about on this show many times, I think you find you've heard this on your show. You've already talked this morning on your show. As you know, and you cover every day on Bloomberg.
We've heard a lot of guests talk about that.
I mean, your show is incredible.
Bloomberg surveillance. We're talking about it. How did I forget Alan Iverson? Fantastic player.
I thought you said that we were going to stop
That's
this.
when the product was good.
Oh, really? So you're still going to go back to that?
That's when the product was good.
Are you going to go back to
Now the product is not very good.
Why is it not good, John?
It's a tedious thing to watch. I find.
It's fun in
The
person.
players aren't as good. And LeBron, and I'm going to get stick for this, LeBron throws himself on the floor all the time. And given that he's like the guy, the franchise guy right now for the NBA, not what Jordan was.
Slippery slope though, and
Sure.
about football. Right? And when you get football, and the people in terms of, oh my God, my left arm.
Sure.
You know,
But these guys are like 7'4" and 250 pounds.
Okay, Fred, this is not. Abort. I'm going to just abort right now.
We can do that later. Okay.
And they're the world champions, Jonathan.
All right.
You should know that.
I didn't expect you to.
Synchronicity.
I didn't expect you to south intro. I didn't expect you to south intro. We'll do that in a moment. All right. Stand by. More to come. Looking forward to this conversation. Futures right now on the S&P, positive by not even a tenth of 1% on the S&P 500. On the Nasdaq, just about unchanged. Some single names out there worth having a look at. Before we get to it, I want to talk about the commodity market. Crude down for 5 sessions, the longest run since August, pulling back even as geopolitical risk stays heightened. WTI is down by another 2%. WTI crude this morning, 64, up double digits on the year so far, but with a pushback over the previous 5 days.
Yeah, pushback because today we have diplomatic table happening right now in Geneva. You have the U.S. officials meeting, had breakfast this morning with the Omani foreign minister, and they're meeting with the Iranian counterparts. Potentially there is an off-ramp to what we've seen in terms of the really insane military hardware right now in the region. And we heard from Singular, and they say they don't think anything in terms of a strike would happen just yet. That may be a few months out.
The flop is what I just got. Literally, messages from Bloomberg subscribers. The flop instead of the bomb.
Yeah, well,
There you go.
I agree with you.
Bad product. 2 hours away from the cash open. Morning movers. We're Danny Berger. Hey, Danny.
Hey, John, yeah, some important ones this morning, and NVIDIA is the one everybody is checking. And I guess it's good that the shares are now moving up. There was this big narrative of a disappointment. But for NVIDIA, I mean, options were pricing a 30% move in either direction. So 1.6% is quite tame. A huge beat for fourth quarter revenue, 70% above expectations. First quarter beats as well. But of course, there's just always kind of like the whisper number with NVIDIA that people are always expecting more. They did point out, especially for their gaming division, which obviously makes a smaller slice of the pie now, that they're still contending with a memory chip shortage. And that was enough to spur an even bigger move for a different stock this morning. Let's check out what SanDisk is doing, because it is the biggest gainer of the mega cap companies this morning of the S&P 500, up 3.2%. Again, just because of those comments from NVIDIA that there's this memory chip shortage, which we already know about, but that was enough to move SanDisk to this. Also looking at some breaking news just in the past 30 minutes, Victory Capital coming in with a new bid for asset manager Janice Henderson, $49 a share. They say that this beats out what was already agreed upon for a bid from Treon and General Catalyst. Again, that deal was already agreed upon, but Victory Capital coming out this morning saying we have a superior bid, we're offering more money. Shares are being priced at $53. Perhaps we might have a bidding war in our hands. John.
Danny, thank you. Appreciate the update. More from Danny in the next hour. On our radar this morning, results from NVIDIA fell into a gross Wall Street, the company facing a critical shortage of memory chips and uncertainty in the Chinese market. The CEO insisting the AI boom is delivering massive profits. Elsewhere, Amazon's full $50 billion OpenAI investment is reportedly on the line. According to the information, the deal hinges on OpenAI going public or reaching human-level intelligence. And finally, the Netflix co-CEO reportedly heading to the White House today, according to Politico. Sanders will discuss the company's potential acquisition of Warner Brothers. The visit also following pressure from President Trump to fire the Netflix board member, Susan Rice.
This is the speculation we've been hearing. Is this going to be ultimately a question of Larry Ellison versus some of the board members at Netflix, and who is the political preference of this administration? This whole thing makes me uncomfortable, because when we start talking about antitrust, how does this play into that? I mean, where does the regulatory overlords think about this in terms of who you say yes to and who you say no to? Is it about antitrust and competitive, or is it about maybe something else?
Who is the regulatory overlord
Yeah.
in this case? Is it just one man in the White House? Is that what this comes down to?
Potentially, but we don't even know actually if the Netflix CEO is going to be meeting with President Trump. We just know he's going to the White House. He's potentially going to meet with some staff. But I was thinking about, when I heard about he's going to the White House, it comes after President Trump said we got to get rid of the board member Susan Rice. Remember when Trump said that Intel had to get rid of their CEO, and then all of a sudden they were best friends, and Trump made an equity stake in
Is he
Intel?
buying Netflix?
You actually don't know what the. You think you might know the outcome might be? You actually don't know based on what happened in the past.
That's a really good point. The stock is up this morning by 0.75%. No one thinks he's buying Netflix, just to clarify. Let's keep on checking. Nvidia CEO Jensen Huang saying $700 billion in AI-driven spending from hyperscalers this year might not be enough. Lumen Technologies saying this time in the race to develop AI infrastructure, the company announcing a new partnership with Anthropic to build out a fiber network across North America. The Lumen Technologies president and CEO, Kate Johnson, joins us now from more. Kate, good to see you. I should say hello properly this time.
Yeah.
Do you want to start in Lumen Field in Seattle first? Can we start there?
I think we covered it.
When did that relationship begin?
The Seahawks and Luna, maybe 20 years ago. The sponsorship, yeah, and it's been quite an evolution. We're excited.
This company's changed a lot. A couple of years ago, summer 24, $1. $1 a stock. What's changed? What have you changed to get from that position to where we are today?
We have changed everything. We've turned around the capital structure through a couple of important transactions, sold $13 billion of private connectivity fabric, solar fabric in the home business, so we could double down on enterprise and double down on digital, reposition the company to become the trusted network for AI, total culture transformation, so our people are empowered to actually focus on growth. It's a new day for Lumen.
How painful has the transition been, given that this is new technology that changes all the time? The skills are quite different.
Yeah, so it's adaptation, right? I mean, it's about acquiring new skills. It's about injecting new skills into the company. It's about reimagining how assets that have been around for a long time provide new value. It's a total refresh. We find it very energizing. AI is very disruptive, but poses a huge opportunity for our growth because it proliferates data, and we move data for a living.
How much easier is it for you to raise money, given the fact that there is this buy-in right now from Wall Street in the build-out of fiber connectivity, the build-out of what is necessary to power the AI hopes and dreams?
Well, honestly, we don't need to raise money. We fully funded the next several years of our transformation with the cash that we've gotten from deal making and from redoing our capital structure. So we're in a great place. I think you'll continue to see us tweak our capital structure, continuing to opportunistically reduce leverage and go after great rates. So, I mean, we're in a great place right now.
When it comes to one of your major customers, partners, Anthropic, are you concerned a little bit about the pushback Anthropic is getting in Washington, D.C.?
So look, Anthropic is a great partner, and they tapped us to be the trusted network for their AI services. So we're super proud of it. We're connecting their data centers, and we're moving at lightning speed with them to help them grow. But the question remains. New tech often raises complex questions. We've seen this movie before with public cloud. And, as that discussion evolves, I think it really points to the fact that we probably need stronger policymaking muscle, stronger governance muscle, and adjudication. So we're watching it quite closely.
Well, what if the DoD actually says they are supply chain risk?
If there's supply chain risk deemed, we will obviously, as we always do, comply with the full extent of the law, federal regulations, and contract requirements.
Does it give you pause about establishing a relationship, given that's on the line at the moment?
It doesn't, because no matter what the landscape is at the model level, everybody needs their data to be moved from anywhere
to anywhere quickly, securely, effortlessly, and we're sticking to that, which is several abstraction layers away from the discussion about the model
Things
itself.
are happening really, really quickly, and the numbers, the sums involved are absolutely ginormous. We had an individual sat in your chair, I think maybe a week ago to the day, who turned around and said that this capex boom is the biggest bubble he's ever seen, and the constraints are going to come from things like energy. Can you give us the counterpoint to that? Because I'm sure that's something you hear a lot as well.
For sure. So there's a couple of different layers to this problem, right? Whether or not there's a bubble, it's disruption. There are going to be winners and losers. There are going to be value propositions and business models that are changed and incumbents that are threatened. And who wins at the model layer, who wins at the services layer, that's up for debate. What stays constant is the need to move data from anywhere to anywhere, and that's what we do for a living. We also got paid up front for building out all the infrastructure. So we're helping build the supply side of the AI economy, and we were able, to take in all of that cash up front, and it'll take several decades. We have more in pipe, so we know there's more coming along. I think on the demand side, it gets really interesting is as enterprises start to consume, those services, what does that look like? And I think that's where a lot of the adaptation that we talked about earlier needs to happen.
Aside from some of the bombastic headlines about AI being a bubble and data centers being a bubble, when you talk to people, one of the fears is the data center that isn't near a big city, the data center that's out in the middle of Tennessee, and whether that becomes a stranded asset. You're kind of the answer in terms of connecting all of this. How big of a concern is that? I mean, do you think that the connectivity between some of these more remote data centers is feasible over a longer term with a bigger load?
Honestly, we already cover a lot of the remote data centers, and the ones that are being built are looking at all the constraints, energy, fiber, etc. And we're right there in partnership with them as they build those plans. So our coverage is an asset. It gives us an advantage in that marketplace, and we're leaning into it. It's how we're winning so many of these contracts. From an energy scarcity perspective, there's a couple different things. We have a programmable network that allows companies to move data anywhere very quickly in real time. So we are actually energy's best friend because we can actually pivot workloads to markets where there's more energy available or where the pricing is more favorable.
The Citadel versus Citrini 7. I just want to go to this because it really speaks to what you're talking about. The whole Citadel comment was that the amount of energy that would be required for the kind of productivity and human replacement that Citrini was talking about totally undermines the whole argument. And it was so far behind it that it just seems absolutely impossible. At that point, just getting humans to do it is much easier. I mean, how big of a constraint is the energy picture right now?
I think right now the problem is that the workloads and data are trapped in markets where there are constraints on energy. But if you look at all of the energy that's available across all the markets in aggregate, there's plenty of energy. So the question is, can you move the processing to where the energy is available? And with a programmable network from Lumen, the answer is yes.
We've explored some of these issues with you before. I'd love some deeper insight on this particular topic. The difference between this moment compared to, say, the internet of 30 years ago. Back then, the telecoms weren't the people who made the massive money. The massive money was made at the application layer with some of these big tech firms that came along, like the Amazons, the Metas of this world, that produced the kind of things that took advantage of the infrastructure that was built for them. Is this different with AI?
It's different for a couple of reasons. Number one, there was a huge overbuild at that time, and every project looked like a great project for telecom companies. They were also in the utility mindset where they were charging rents, and it was kind of like, oh, there's going to be this huge traffic boom. We can't wait to get all these orders. This is different because it's not just about pipes. It's not just about bandwidth. It's about the capabilities to connect that bandwidth to the application layer. It's how everything talks to each other. That's the essence of our strategy, is this digital platform actually makes the network programmable, just like compute and storage were made programmable in the world of cloud. We've promoted network to the same level, and now it's become an incredibly valuable asset. Manage your energy, manage your workloads, push your data from anywhere to anywhere, and data applications and people are spread everywhere, so you need that fiber.
The transformation of this company has been amazing to follow. It's great to catch up with you. Welcome back anytime. It's good to see you.
Thank you so much.
Thanks for dropping by. Thank you. That was Kate Johnson there, the Lumen Technologies President. and CEO.
Some real fascinating food for thought, especially with the pushback that we're hearing in terms of stranded assets. Well, they don't become stranded if you have a connector, and that seems to be the solution here.
Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Yahara drops by for more. Hey, Yahara.
Hi, John. President Donald Trump and Ukrainian President Volodymyr Zelensky holding a call to discuss next steps for peace talks. Negotiators from both countries plan to meet in Geneva today. Sources telling us here at Bloomberg another round of U.S.-led bilateral, including Russia, could take place next week. The president is also preparing to host big tech at the White House next week. The companies, including Amazon, Google, Meta, and Microsoft, will sign a pledge agreeing to supply their own power for AI data centers. Data centers are, of course, facing opposition in communities across the U.S. as people blame rising utility bills on the facility's huge electricity consumption. And Salesforce trading lower in the pre-market, down 2.7%. The company giving a lukewarm outlook for growth in the new fiscal year. Its forecast fueling concerns that the software giants will lose out to new competition in the age of AI. That's your Bloomberg brief, John.
Hey, Yahara, thank you. Appreciate it. Our next on the program, big text, big spending.
We struggle a lot with the absolute dollars that are being burned. There will be giant businesses created, but the amount of capital being thrown at it and the losses that some of these companies are generating is absolutely mind-boggling.
That conversation up next with Matt Brill of Invesco, live from New York City. You're watching Bloomberg TV.
Shipping is the backbone and the engine of global economy. Practically everything our society needs gets transported by sea. But the mere size of it means that it's responsible for 3% of global emissions. Global regulations are vital to progress society towards net zero. Today, the industry is seeing a delay in making decisions. This creates an environment where there is a level of uncertainty of what happens next and what that means to the world. What we've learned being a 100-year supplier for the marine sector is that times of uncertainty, the best thing to do is to up the collaboration. When we work with our customers on research and development, catalyst technology for methane abatement, what dual fuel vessels to choose, we can really help them beyond just being their supplier and work with them to help the solutions of tomorrow be ready when they need them.
At Suzlon, we strongly believe that our energy choices will define the future of planet Earth. The top three critical elements while choosing our source of energy is affordability, reliability, and more importantly, scalability. It's very important that we are able to scale up the source of energy at an affordable price to be able to deliver reliable power for the needs of mankind.
And debates, plus exclusive conversations with Finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every Wednesday at noon Eastern, only on Bloomberg Television.
The trading day is about to start.
And you're already looking for that edge.
The Open Trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg. Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlin Ahmed in Davos, Switzerland, and this is Bloomberg.
Stocks just about unchanged. Steady waters here on the S&P 500. Beneath the surface, though, you know it's been vicious. Continues to be. Salesforce down in the pre-market. We'll talk more about that in the next hour. On the Nasdaq, just about unchanged. The Russell positive by 0.3%. Under surveillance this morning. Big techs, big spending.
Trying to predict when these things are going to pop is a fool's game. I do believe that it's people underestimate the long-term aspects of it, but they sure overestimate the near-term aspects. We struggle a lot with just the absolute dollars that are being burned. We think it's very real though, and there will be giant businesses created, but the amount of capital being thrown at it and the losses that some of these companies are generating is absolutely like mind-boggling.
So here's the latest this morning. The Nvidia CEO, Jensen Huang, looking to reassure investors that hyperscalers will deliver about $700 billion capex this year. Bill, as Invesco writes, the market continues to raise for hyperscaler issuance, with two having already come this month, totaling $45 billion combined. Matt joins us now for more. Matt, welcome. You're an expert in this space. I just want to know from your perspective what the risk is of overbuild and allocated to stories that won't work out.
Yeah, that's a great question. I think unfortunately or fortunately, we're probably not going to find that out for several years. So over the near term, the risk is more of the technicals and the supply that it's putting on the market. The longer term, we'll have to figure out if there's actually end demand for this. But you heard Jensen Huang last night. He said the compute power demand or computer demand is just off the charts. Obviously, he's got to say that because he needs his clients to I think he's telling the truth. And the reality is we're starting to see the expansion at the end user base as well. So the expansion of margins is really picking up, and they're going to keep buying from them. So I think overall this is good, and they're afraid of the risk of missing out here and the risk of falling behind. So they're going to keep spending, and that means they're going to keep borrowing.
We've heard that directly from companies like Alphabet. How impressed have you been, Matt, by their approach to the debt market, their ability to diversify risk across different regions, across different maturities?
Yeah, so it's really three-dimensional what Google or Alphabet's been doing, where they issued all the way from 3 years in the US out to 40 years, and then they issued in sterling and they issued in Swiss francs as well, and they did the 100-year sterling bond. So basically 3 different currencies and probably something around like 8 or 10 different maturities, and all the way spanning from 3 years out to 100. So they're diversifying their sources. I'd say it's pretty incredible what their debt has done. If you look at the 3-year, it's still tighter from where they issued. Their 30-year and 40-year bonds are about flat, but everything else is tighter. So there's still demand as much debt as they've printed. They're still doing well. That's very contrary to what you've seen from Oracle, where their debt has actually continued to move wider on a little bit of pressure of just the amount of supply that they've done as well.
Matt, how much does this really change the investment grade index, given the fact that we're talking about 40-year Google debt, and we don't understand what role a search engine will be or have in society in 30 years, let alone 5? I just wonder how much you're seeing risk getting built in that isn't properly reflected in spreads.
Well, we're seeing steep curves in tech, and the steeper curves are reflecting the fact that you can probably predict for a few years where things are going to be, but not much further than that. And so you're going to generally believing in the balance sheet, and you're believing in management that they're going to do the right thing longer term. But we don't know from a technology standpoint how quickly things will change. So in the instance of Google, you got somewhere around a 60 to 70 basis point 3s to 40s curve. So it's reasonable. In a name like Oracle, it is greater. It's a bigger curve. It's steeper curve. So I always point out to people, these are liquid bonds. These are multiple billion-dollar bonds. So we need to get paid a steep curve, and then we need it to be liquid, because if things change, we're going to need to sell it. And I think that is key, because you can lock up capital in this market very quickly. There's a lot of private debt deals that are going on. There's a lot of illiquid deals that go on. And I'm less interested in those for the long term, because these things can change, and I need to be liquid and be able to get out of them.
You're talking about a potential $400 billion of issuance for investment-grade corporate debt in the United States this year. It's about a fifth more than what we saw last year. I mean, at what point would that be concerning? Where is the money coming from? Is it just in cash? Is it coming from overseas? Is it coming away from Treasury issuance?
It's a little bit of everything. We've been hoping that the money would come out of T-bills and cash, and that the T-bill and chill trade would go away, but it's been pretty tough to break that. But it is generally been coming from annuities and pension plans. You just had the holiday over in China for a little bit there, and so in that regard, that took away a little bit of demand for a week or so. But for the most part, you're seeing the yield-based buyers stepping in, and I have some concerns that if you break below 4% on the 10-year Treasury, that's going to start to dry up a little bit of that demand. So we need the yields to stay elevated. We've been in this zip code for a while where yields are elevated but spreads are tight. If that were to change and companies still continue to issue at this pace, I do think credit spreads would have to go wider.
Matt, just finally on the pockets of stress we're seeing in private markets at the moment, we're seeing some companies having conversations about redemptions, questions being asked about their ability to meet them. When you start to see signs of that starting to emerge, is there a risk that more liquid, high quality assets have to be sold because some of these companies that have got exposure in those places where they can't sell need to raise some capital?
100%. I mean, at the end of the day, when there's a crisis that hits, you sell what you can, right? So you generally sell your most liquid, and you obviously are going to sell your best quality stuff as well. So we'll see if some of the sales that have gone on, the published sales that have been out in the news, if there's been cherry picking or not. We'll have to find that out. But I do think that does create opportunities for us. The problem is it creates a lot of pressure on the market over the near term. But this is going to be a bond pickers market throughout the year. There's going to be potentially some panic selling. There's going to be some forced selling. Overall, we generally like that. We don't like the path that creates at that time, but it does create opportunities for us. We're looking at the software space. It does feel a little bit early there now, but software, BDCs could provide a lot of opportunities on the year. We just got to get paid and we get a little more comfortable of where the market's going to be headed in the future.
Matt, that's another way of saying you expect more pain. Is that fair?
that is fair, exactly.
Matt Brill of Invesco, thank you, sir. Good to see you. Expecting more pain in those pockets of stress we've seen already.
What's interesting to me is how much public credit markets feel so good about the pain in private markets, because they're saying this is isolated to them. There's going to be pain. We can be on the other side of it, but we're going to benefit. And guess what? We're sitting pretty because we're being responsible. It's their problem.
It's hard to keep that contained though. Once it comes to the surface, you sell what you can, not what you want. That's when problems start.
Especially if it is fundamental. And this is really the ultimate question. Is this fear for fear itself, or is this something problematic with the business models? And probably it's something in between. And the question is how that shakes out.
The stock story is pretty calm so far this morning. The index level, once again, the S&P within about 0.5% from all-time highs on the S&P 500. Futures going nowhere to positive, maybe 0.1%. In the next hour of Bloomberg Surveillance, we'll catch up with John Bilton of JP Morgan Asset Management. Looking forward to speaking to Pierre Fadegut of New Street Research. On the surface, Nvidia knocked it out of the park, and yet the stock is not rallying hard. We'll talk about that in just a moment. Plus, Nina Richardson of ADP, another look at the labour market. Jobless claims just around the corner, 34 minutes away. And we'll talk tech more broadly with Tony Wong of T. Rowe Price. The third hour of Bloomberg Surveillance up next.
In this episode, we explore why the era of simply searching for answers is over.
Agentic AI has to be designed around responsible AI. Can we audit? Can we trace? Can we control? The risk we run is we create systems that recursively learn and change without the signal and the switch to turn them off.
Bloomberg Invest, where intelligence meets capital. In the heart of the financial district, powered by Bloomberg's award-winning journalists, bringing together the market's most influential minds.
A big part of our job thematically is understanding the risk environment we're in. We are facing a once-in-a-generation technological disruption.
We will continue to have a convergence in credit markets.
Liquidity at moments in time when there's a lot of volatility is challenging.
Bloomberg Invest, March 34th in New York.
In the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300, and the NASDAQ peaked 3.5 years later over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there will be rebalancing, and it's hard to call it because the technology trend in the investment is real.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Matei. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. Sector is really propelling this yield forward.
Yeah, the hope is this will open up new
markets and provide some additional liquidity.
Of course, now they're going to have to better. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg this weekend, bringing a little Bloomberg into your weekend routine.
Guys,
Buckle up.
in case you missed it, on the close.
Beef prices holding at a record high, with the average consumer paying about $7 a pound for ground beef. This is the Trump administration's new dietary guidelines are set to actually boost demand for the protein. I'm sure when you saw that inverted pyramid, that had to be music to your ears, Nate. The idea that at least you have the government's backing in us eating more beef. Kind of square the circle for us as to where you think this goes.
Demand is an all-time high. Having a ribeye at the top of the pyramid there is certainly going to lift demand at a time where supply is at an all-time low. We've always noted on Lost Steaks that beef is a high-quality, complete protein that's good for the human body, and it's delicious, and so it's not a surprise it's there. But certainly, being at the top of the pyramid and the U.S. government coming out and pointing that out is going to drive demand, and so it's going to further exacerbate what we've been seeing on price.
Don't miss the close live every weekday. In case you missed it, on Bloomberg Brief. For all our senses, yes, inflation's almost dying, but a lot of those trends, whether you look at shelter inflation, ex-shelter service inflation, they are sort of heading low. I think that's what will give comfort to the Fed. If the labor market stays okay, we stay in this low higher, low fire, I think the market's okay with the second half of the year rate cuts. Don't miss Bloomberg Brief live every weekday.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest. This is Bloomberg.
I'm not sure the market is actually reflecting the strong nominal growth environment.
The mood around technology remains very guarded.
The bar is always very high. It's a tale of two markets almost.
There are incredible things coming out there for AI. It's not going to be quite on the sort of Wall Street timescale.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. The price action looks like this. Unchanged on the S&P, on the Nasdaq, likewise on the Russell. Very close to all-time highs. Not encouraged by some fantastic numbers coming out of Nvidia. We'll talk more about that a little bit later. In the bond market, 10 still very close to 4%, even though the outlook apparently is bright for the US economy. Yields at 4.05% coming into this at 8:30 Eastern Time. Another read on the US labor market. Jobless claims are just around the corner.
It's really going to be of increased import given all the speculation around how much you can see this divergence between the AI hopes and dreams and what we're seeing in the underlying economy. It feels like things are holding in. We saw that really good jobs report in terms of what came out last month. Can we see a continuation of that given some of the layoff announcements, et cetera? Or do we see a re-acceleration, which is what a lot of people, at least the optimistic side, project? Incredibly important number this is going to be from the likes of Governor Christopher Waller, who said he's going to really think about where the labor market is and potentially it's going to push back his dot on where he sees the next interest rate cut. Also, you mentioned that Citadel Security report. Security has this doomsday scenario. Citadel's like, look at all the software